Hello, Capita Friends and Network. Welcome to 2025. There are many new rules and limits for this year when it comes to taxes, and there's no way for us to cover everything in this video. So talk to your advisor, and we're excited to get going with you here in this new year. Let's dive in. Today we have a packed agenda. First, we're going to talk about deadlines. Second, we'll cover changes in tax limits and tax lines. Third, we're going to talk about Social Security and Medicare changes. Fourth, we'll go over retirement contribution changes. Fifth, we're going to talk about important retirement ages. Sixth, we'll talk about annual planning that you should be doing. And then last, number 7, is common tax mistakes. Again, this is a very packed schedule, so we're going to dive right in. So for deadlines, tax filing happens on or before April 15th. If you extend, you can go to October 15th, but don't forget to make an estimated payment for your tax liability by April 15th, even if you extend. Receiving documents. This is always tricky because each custodian has their own time frame for how quickly they will send you your 1099s and other tax forms. You should expect to receive your first wave by the end of January. The second wave approximately mid-February, and then sometimes there are revisions in February to early March. When a brokerage firm receives notification of an error or a change to how the tax was reported on one of their investments, they have 30 days to notify you and send out a new corrected 1099 form. So be careful you don't jump the gun too early by filing your tax returns. It can be a real dissatisfying experience for you to have to file an amendment only a couple weeks later to your previously filed tax return due to a corrected 1099 form. Okay, IRA contributions. You can make an IRA contribution up until the date you have filed or April 15th. In particular, I'm talking about for 2024. You can make a contribution for 25 anytime throughout this year and up until April 15th of the following year. But if you want to make a contribution and have it count for 2024's income, that needs to happen by the midpoint in April. And they do this because eligibility for IRA contributions is dependent upon your income. And some people don't know exactly how much they'll earn until the year closes out. So we have this window for the first 3.5 months of the year to be able to make those IRA contributions. Okay, estimated tax payments are due in April. That's on the 15th of April. That's for Q1, July 15th for Q2, September 15th for Q3, January 15th for Q4. Remember that you need to contribute or pay enough in taxes in order to avoid being penalized. Those thresholds depend on your income. It's usually 90% of this year's tax liability, or 100 or 110% of last year's tax liability. So if you meet one of those criteria, you're safe. If you don't, that's when the IRS can give you a little bit of a penalty for not sending enough throughout the year. Okay, marginal tax brackets are the lines at which the rate increases as you make more money. It's called a progressive tax system. So your first little chunk of income is taxed at 10%. The next section is taxed at 12, and then 22, 24, 32, 35, and 37. A common mistake here is people think that as soon as they cross, for example, from 12 to 22, that all of their income is retroactively taxed at 22 down to their first dollar. That's not how it works. The first chunk will always be 10%, and then 12, and then 22, and so on. So these rates, we've had them for a while, ever since the Tax Cuts and Jobs Act. If that act sunsets, like it is scheduled to in the end of 2025, in 2026, we will receive new rates. So the 12% goes to 15, 22 goes to 25, 24 to 28, 32 to 33, and 37 to 39.6. So most brackets experience a change of approximately 3%. So that would be an additional tax that we would all pay on the same amount of income because the rates are higher. Okay, let's talk about long-term capital gains. The rates are still 0, 15%, 18.8%, and then 23.8%. Now, when you look online, you're going to see 0, 15, and 20. The reason I say 0, 15, 18.8, and 23.8 is because after the Affordable Care Act, a 3.8% net investment income tax was introduced for people who have over $200,000 of income, if you are a single person, or $250,000 of income as a married individual. So what's happening here is you have enough income that they're going to charge you this extra 3.8% on any investment income, capital gains, interest, dividends. This is all investment income. So be aware that you could potentially get capital gains out at a 0% tax bracket if your income is low, 15% if it's moderate, and then as it gets higher, it will go to 18.8 and 23.8. These are the various brackets you might experience for long-term capital gains. It's important to understand standard versus itemized deductions, both when you're filing your taxes and when you're thinking strategically about what to do through the year to minimize your taxes. Itemized deductions is when you add up all the things that the government has said, these are things we will let you use to reduce your income. And you can add all these up and we'll let you use all of them. Or you can just take this standard number over here and you don't have to worry about tallying up all your itemized deductions. Most people should do it anyway and figure out which is greater, the standard or the itemized deduction, and take the greater deduction because that will reduce your income by more. The standard deduction has increased a little bit. For a single person, it's gone from $14,600 to $15,000. For a married couple, it increased from $29,200 to $30,000. Head of household, $21,900 up to $22,500. So each of these standard deductions has gone up a little bit, which means that it will reduce your taxable income by a little bit. Nothing huge here. The standard deduction will decrease if the Tax Cuts and Jobs Act sunsets. So the standard deduction will be cut roughly in half. We won't go into all the numbers, but understand that the standard deduction decreases in half. The tax rates go up by about 3%. Exemptions come back, which is a good thing. It's kind of like a standard deduction. So a few changes, those are the three key ones that most people will need to be aware of. For those of you over 65, you have an additional deduction available to you, and that's also gone up a little bit. For single filers, it used to be $1,950, $1,950. It's gone up to $2,000. And then for those who are a couple and both of you are over 65, it now is $1,600 each or $3,200 as a couple. So be aware you have that extra standard deduction if you are over the ages 65. Okay, we talked about exemptions so far. Exemptions would be approximately $5,300 per person. So this is basically saying add up all the people in your household that file or are included on your tax return and then multiply that by approximately $5,300. Those would be the exemptions you'd be able to take. This is not a 2025 thing or a 24 thing. This is, again, if the Tax Cuts and Jobs Act expires or sunsets, this is what it would be like in 2026. We're always thinking ahead. We want you to be planning with the future in mind. The best tax strategy is usually when you compare multiple years against each other and take advantage of the difference in those rates. Okay, let's talk about Social Security and Medicare changes. First, for those of you receiving benefits, you got a raise. It's called a cost of living adjustment, COLA. That was 2.5%. Now, you got a raise, but you also have to pay more in Part B Medicare premiums. That went up from $174 to $185. For those of you who have high income, and this is considered $106,000 for a single person, $212,000 for a joint person, you will hit the first line at which the government makes you pay more for Medicare Part B. It's called Income Related Monthly Adjustment Amount, or IRMA is the acronym. The first IRMA line is at those two thresholds I gave you, 106 and 212 for joint, and there are multiple thresholds, and your Part B premium will climb at each of those thresholds. For those of you who are working and paying into Social Security, you pay 6.2% and your employer pays 6.2%. That combined is what goes in to help create and justify your Social Security income in retirement. You only have to pay that 6.2% Social Security tax on the first $176,000 of income. I say only, but in reality, that's a good amount of income. But after that line, $176,100, after that line, you do not have to pay the 6.2% Social Security tax for the rest of the year. When January 1 rolls around again, You'll begin to pay that tax again until you reach the threshold once more. Okay, we're going to talk about some retirement contribution changes, both the amounts you can put in and various income limits for contribution eligibility and deductibility. For regular IRAs and Roth IRAs, they call them traditional and Roth IRAs, the limits haven't changed. It's still $7,000 for a regular contribution, or an extra $1,000 for those of you over 50 years old. That's called a catch-up contribution. For 401ks, 403bs, 457s, thrift savings plans, all of these retirement plans, the contribution limit is $23,500. That's about $500 more. The standard catch-up is still $7,500, but the next part is brand new. We've never seen this happen like this before, where they picked 4 specific ages: 60, 61, 62, and 63. If you are one of those 4 ages, your catch-up limit is actually $11,250. Again, that's brand new for 2025. And if you're trying to figure out, okay, where do I land and how do I contribute to my 401k? What should I do? Of course, our advisor can help you walk through these lines and the ages and the numbers and ensure that you're contributing the max if that's your goal. Okay, there are income limits for contributions to IRAs. For a regular IRA, they will give you a tax deduction. A traditional IRA, you'll get a tax deduction for that contribution because you're turning it into pre-tax money. However, if you make too much, they don't give you that deduction. That line is quite variable based on whether or not you have a 401k or a retirement plan at work, and whether or not your spouse has a plan at work. So we won't go through that whole table. That's another item that we're happy to help you with. But just be aware you get a deduction if you're under certain lines. For a Roth IRA, it's a little bit different. They don't give you a deduction because that's after-tax money that you hope will grow tax-free forever. There's not a deduction line, there's just a contribution eligibility line. So if you make too much, you cannot contribute at all to a Roth IRA. And those income limits have gone up a little bit. They are now $165,000 for a single person and $246,000 for married filing jointly. And then lastly, it's all the way down at $10,000 for married filing separately. It's one of those areas where it really is painful on the married filing separately situation. Okay, let's talk about HSAs. This is an account that you put money in to save for future medical expenses. You get to put it in tax-free, and if you use it for medical expenses, you get to take it out tax-free. And the limit of how much you can put into these accounts has gone up a little bit. So for an individual, it's $4,300. For a family, it's $8,550. And then there is a catch-up of $1,000. Now, I'm going to pause us for a moment here because the catch-up age is 55 for an HSA. The catch-up age for IRAs and 401ks, that's all 50. That's an important difference. Don't do the catch-up to your HSA before you reach 55. And then remember, there's another catch here. The match. If your employer is giving you, let's say, $1,500 towards your HSA, that needs to be included as part of your maximum contribution limit. That doesn't work like that for a 401k. The match into a 401k does not go towards your $23,000 and change that you can put in. It does go towards your individual or family contribution limit for an HSA. So that key distinction is super important so that you don't accidentally over-contribute to your HSA. Capita has specialized in the retirement transition. So we're going to go through many different ages between age 59 and a half and age 73. These are all really important milestones that you reach during that 14-year window. Age 59 and a half is the age at which you can take penalty-free withdrawals from your retirement accounts. It unlocks rollover capability from your 401ks as well. But at that point, you don't have to worry about that 10% penalty generally when you take money out for general purposes from your retirement accounts. Age 60 is the first age at which a surviving spouse can take a survivor benefit for Social Security. That's different. That's 2 years earlier than your own benefits. Age 62 is when you can take out a retiree benefit on your own earnings record. Age 65 is when you become eligible for Medicare. You can get on it if you would like to. Now, be careful. Many of you have an employer plan at work. It's called qualifying group coverage and your mailbox fills up full of mailers telling you you must sign up for Medicare, when in fact it's not true. If you have qualifying coverage at work, you do not need to sign up for Medicare just yet. And if you would like, you can save that Part B premium until the time comes at which you retire or have a life event, and then you can sign up for Medicare at that time. Age 66 and 8 months up until age 70, that's the full retirement age. That's the age at which you receive your full Social Security benefit for having waited until the full retirement age. Age 70 is the age at which you get the maximum delayed credits. So your Social Security benefit is climbing because you're not taking anything. And of course, we're happy to run the break-evens and all the analysis to help you determine when to file. But at age 70, you're no longer receiving any growth on your benefit. And if you haven't filed, it's time to seriously consider it or get on it. Age 70 and a half. This is when you can do one of our favorite strategies. Is called a qualified charitable distribution, QCD. This is when you take money out of your IRA, send it directly to a charity, and instead of having to go through the whole tax process of, is it an itemized deduction? Is it more than a standard deduction? Do I get to count it? And do I get to use it to offset my income? That whole process can be avoided by sending it directly from your IRA to the charity, and it just vanishes from your income altogether. So it's a wonderful tool for giving charitably and minimizing your tax return. That is age 70 and a half. At that point, if you have IRA money and you regularly give to charities, we oftentimes tell you you might never pay your charitable giving from your bank account ever again. It's a wonderful way to save on taxes. Age 73 is our last milestone age. This is the age at which the government says, you know, you have this account on which you haven't paid taxes, IRAs, 401ks, and so on. And they've given you that break long enough, and they're going to force you to take money out every single year in order to include that on your tax return and pay some taxes on it. The first year you can wait until April 1st of the following year. If you choose to do that, just be aware that you'll end up taking 2 payments in 1 year. That could push you over certain lines and not be advantageous for you. Again, we're happy to help with that, but you have to start this process at age 73, and then they require you to take a higher percentage every year for the rest of your life. And those that inherit your accounts will also be subject to minimum required distributions as well. Okay, let's talk about the annual planning that needs to be done. So your advisor and their supporting team is working hard for you. So during your annual review, we want to go through several topics and make sure that we cover them. One is cash flow, meaning any money coming and going from your overall life, your bank accounts, just what you're living on, your projections of that, the safety of your long-term cash flow, all of that. That's cash flow. Then we also want to cover investment strategy. How do you feel about the risk, the portfolio, the progress? How are we doing at reaching your overall goals? And then third, tax strategy. So this is tax analysis and any action that we can do to reduce your liability. So it's really important that you share any changes to your income, expenses, major life events you may be having, or really just any preferences that you have or feelings that you have where money and your life comes together. We can help you with all of that. We're going to talk about a couple common mistakes, and then you've made it. So the common mistakes that we see are folks jumping the gun a little bit too early. The documents might not be ready, you file your tax return, then you get another document and have to amend the tax return. We've already talked about that a little bit. Second mistake is forgetting to account for non-retirement accounts. Dividends, interest, capital gains. You might not have taken any money out of your accounts, but if it is a normal brokerage portfolio, not a retirement account like an IRA or a 401k, if it's just a normal brokerage portfolio, you will get a 1099 for that account. And even though you didn't take money out, you need to include that income on your tax return so that your accountant can account for it and you make sure you cover any tax liability associated with it. We've talked about deductions so far, but the third mistake is folks misunderstanding the itemized versus the standard deductions. For example, sometimes people will make a contribution to a charity and think they're going to get a tax deduction for doing that when they were taking the standard deduction anyway, and the contribution will not allow them to itemize because it's just not enough. So it's important to understand where you stand within standard and itemized deductions so that you don't take a financial action expecting a benefit and then not having that. come to you. One of the most painful and mathematically most devastating is forgetting to tell your tax preparer that an IRA withdrawal was actually a qualified charitable distribution. We talked about how beneficial that is. However, many tax preparers don't have a great way to know that it was a qualified charitable distribution. So it's really important that you tell them. Some custodians are putting a little tag on it that's helpful for you to see, but it's really on you and us to help you know that this is something to let your accountant know that a qualified charitable distribution happened and you don't need to include it as part of your taxable income. Along the same lines with charitable contributions, don't forget to tell your accountant about any money and other things you may have donated to charities. Okay, the next one is more of a long-term mistake that we see, which is an individual may be in a really low tax bracket and then forget to take advantage of what we call headroom within that bracket. Imagine you are in the 0% capital gains bracket. You could be taking capital gains inside the portfolio with no tax cost. Or imagine you are at a 10 or 12% bracket with regular income. We could potentially be doing Roth conversions in that space and moving money from a pre-tax status to a post-tax status at a pretty low rate. So it's really important to understand the brackets and where you land and where you think your tax brackets might be in the future. Okay, another mistake is not thinking about potential changes in tax rates with the end of 2025. This is really hard because with the current administration, we've talked about this, it's hard to predict what will happen with the Tax Cuts and Jobs Act and the rates associated with that. So we want to be thinking about that, but also not betting too much on one way or the other and what policymakers will do. Your Capita team is watching these tax lines and these changes, all of these updates very closely. We are excited to help you. We're excited to serve you. We look forward to meeting with you during your annual review and your regular check-in calls. So please reach out to us and your team with any questions. We really appreciate you, and we hope you have a wonderful 2025.